And let me welcome you to Learning Objective 4 in Chapter 7. So this incremental analysis piece is looking at whether we sell a product as is or process that product further, right? And so basically speaking, if we process it further, so instead of a wooden table without any paint or lacquer on it to protect it, we just sell the wood table as is. If we process it further with the extra revenue we would get from doing that, be higher than the costs to process it further. So this is what we're going to be looking at. Actually, we're looking at it from two perspectives. One is just a company that does what we call a single product case. In this case, this particular company makes tables, Woodmasters. And an unfinished table, they know the cost of their unfinished table is 35 bucks. The selling price, which is the revenue for that table, is 50 bucks. Okay. So they have some unused capacity in their factory. So literally they could process the tables further. And if so, they could sell them at $60 a piece instead of $50 a piece. But because they're processing them further, they're going to have increasing costs. Their direct materials will increase by $2 a table. Their direct labor is going to increase by $4 a table. Variable manufacturing overhead is going up by $2.40 per table, although fixed expenses, fixed overhead is not going to be affected. So the question for Woodmasters is, should they just sell the unfinished table as is, because they're making $50 on each table? They have $35 in cost, so they'll have a $15 profit per table. Or because they have unused capacity in their factory, they can just go ahead and finish them all up, paint them, put that, whatever it is they put on it to make them shine nice. They can sell them for 60 bucks, but they're going to have some increased costs. So what should they do? Well, that's what an incremental analysis will tell us. Okay. We all know that they're selling unfinished goods right here, and their profit is $15 because they're selling them for 50 bucks and their costs are 35. So it's a $15 profit. If they process them further, as we learned, they could sell them for 60 bucks each. Okay, 60 bucks each. But they would have a $2 increase in the direct materials. So direct materials would go from $15 a table to $17 a table. They would have to spend an extra $4 for labor. So per table, $10 goes to $14. And the variable overhead costs are going to go up by $2.40. And so that's going to be $8.40. No change in fixed overhead. So that's still 4 bucks. So the new cost of the table is $43.40. Now they're selling them for $60. The costs have gone up to $43.40. What is the profit? Well, now the profit is $16.60. So it's a larger profit. So how would it actually look when you compare the increase and decrease to our profitability? More revenue is obviously more profit. They would have an increased cost and of $8.40, but they'd have increased revenue of $10 per table. And that means that for every additional table they sell, if they process things further, it's another $1.60 in net income. So should they sell or process further? Well, in this case, if they're really interested in using that capacity and making a little extra profit per table, then they should process further. There are a lot of companies, however, that they make multiple products from their raw material. For example, milk. Okay, when you look at milk, milk can be processed into things like cream and skim milk. Okay, it's a common process to get raw milk into either a state of cream or a state of being skim milk. Okay, so cream has a lot of extra fat. Skim milk, of course, has some of that fat, most of that fat removed in that process. However, this is basically what they do. They could process things further, right? So if they further processed cream, they would be able to produce cottage cheese if they process that cream further. Okay. If they process the skim milk further, they could produce condensed milk. And so the question is, do they stop at this process, sell what they've got, or do they process it further into these other products? Okay, because in the case of a dairy or a creamery, you're going to have a chance to produce other products from your main products. Everything that you've spent from the getting the raw milk and processing to your joint products, which is skim milk and cream, all of these costs are going to be done anyway. So they're called sunk costs because you're already going to be doing all of this to get to your main products here. So those are not going to factor into whether you should further process them into these other products, because these are all sunk costs. They don't matter anymore. Okay. What's going to matter is the incremental amount of revenue you're going to make and the incremental amount of expenses you'll have to see if continuing to process these products into either cottage cheese or condensed milk will be profitable for you. So incremental analysis to the rescue. Here's some general information about our dairy or creamery here. Cost per day. They have the joint costs allocated to cream for $9,000, joint costs allocated to cottage cheese, $10,000. Revenue from all that cream, $19,000. If they keep processing it, they would get $27,000 of cottage cheese revenue. So should they simply just sell the cream as is or process it further? Well, that's what we're going to be looking at. Incremental analysis tells us that if we just sell the cream, there's no additional cost because they've already been assigned in essence. But if we process them further, we would be able to sell more we'd be able to sell $27,000 of cottage cheese rather than $19,000 of cream. But we would have to add another $10,000 of costs, of incremental costs to process the cream into cottage cheese. It's already cream. So there's no additional costs to turn cream into cream, but there are additional costs to turn cream into cottage cheese, and that's why this is here. So their profitability would be affected. If they just sell the cream as is, their profit would be $19,000, as you see. If they went ahead and processed the cream into cottage cheese, they would make a higher amount of revenue, $27,000, but they would add another $10,000 of costs. And so the net effect of processing the cream to cottage cheese is a profit of only $17,000. And so basically speaking, in this case, they would add $8,000 of revenue, but they would also add $10,000 of costs. So if they just continued to process the cream into cottage cheese, that would be a $2,000 loss for them in this case. So should they process or not process? Well, this is easy. They should not be processing the cream any further because if they did, they'd be losing money. Okay. Is the same true for the skim milk? The skim milk and should we move that into condensed milk or should we just sell the skim milk as is? Well, here are the costs, the joint costs allocated to the skim milk. The cost to process that skim milk into condensed milk is listed here. Revenue from skim milk, revenue from condensed milk are given here. So we do our incremental analysis comparison. We show that if we just sold the skim milk as is, we wouldn't incur any additional costs. And so we would have a profit of $11,000 just by selling the skim milk. If we process the skim milk further into condensed milk, right, our sales would go to $26,000 from $11,000. So it's a pretty big jump. Well, what about the extra cost, right? Well, our incremental costs would go up by $8,000, which means that we would have an $18,000 profit if we continued the process and produced condensed milk from the skim milk. And so in essence, in this case, you'd have an increase in revenue, an increase in cost that would be not so high, and a $7,000 profit, additional $7,000 profit from processing it further. And so in this particular case, they really need to process it further. All right, so to sell the product as is or process further, how you make that decision, generally speaking, right, is you need to make sure that the incremental revenue you make from processing it further exceeds your what? Well, it's your incremental processing costs. Okay. So you're already processing things already. This is if you continue to process it further. Okay. This is true. I mean, crude oil, there's certain processing costs to get it to just your regular unleaded gasoline. But then we have that unleaded plus, and we have unleaded, premium or ultra. They put all types of, that's additional processing that they have to do to get to that point. And so is it worth to them? Well, with that revenue stream, being that prices are higher, it makes it worth it for them. Okay. All right, so the do it exercise for learning objective 4 is in your book on page 286. So if you want to look at page 286, that's what we'll be doing it. Easy does it. Manufactures unpainted furniture for the do-it-yourself market. Right now, they sell a child's rocking chair for 25 bucks. Okay. Their production costs to produce that chair are $12 in variable costs, $8 in fixed costs. So that's just to sell the unpainted rocking chair. They are considering whether they should continue processing it and paint it. If they continued processing it and painting it, they could sell it for 35 bucks. However, their variable costs would go to $9 from $8. And their fixed costs would be $2. Okay. So prepare an analysis showing whether Easy Does It should just sell the unpainted chair or go ahead and process it further. So in this case here, they would get a $10 a boost in every chair because they'd be able to sell the chair for $10 more. So that's an increase of $10 toward their profitability, but their costs would increase. Okay, from $8 to $9 additional. I'm sorry, my bad. From $12 to $9 additional. So that's the 21. My bad. And their fixed cost would go from $8 to an additional $2, which is 10. So in this case, they would increase their revenue by $10, but as you see, they would have costs increasing by 11. So overall, it's not going to be worthwhile to process this any further because every time they do it, they're going to see their profit go down $1 per chair. So just sell as is the best thing. Sell the unpainted chairs and let it go. Okay. So that's how we would do the learning objective 4. Learning objective 5 is very brief. It's 1 page, in fact. And in this case, it's simply giving you an understanding of what are the relevant costs if you decide to repair, retain, or replace equipment. And of course, every business has property, plant, and equipment, and so this is very relevant to every business. How do you make that decision? Well, incremental analysis can help us understand those costs and whether it's a good idea to repair or replace, in essence. So this company, Jeffcoat, is thinking about replacing a machine with a new one. Okay. So their factory machine originally cost 110 bucks. It has accumulated depreciation of $70,000. And so it's got a book value of $40,000. It still can be used for 4 more years. The company is considering the new machine. This new machine cost $120,000. It's not going to have any salvage value at the end of the 4 years. However, if the new machine is purchased, the variable costs will decrease from $160,000 to $125,000 per year. And they could sell the old unit for $5,000. So what should they do? Well, incremental analysis is needed to help us understand what they should be doing. Well, the first thing we need to know is if they simply just retain the equipment that they have. They know that the equipment costs them $160,000 a year in variable manufacturing costs, and they're going to keep it for 4 years. So basically, the cost of retaining the equipment would be $640,000. Sorry. So to replace the equipment, well, if they replaced it, you mentioned that the actual variable costs would go down. They would go down to $125,000 per year for 4 years. So in essence, the variable manufacturing costs would drop to $500,000. Of course, they would have to buy the new machine, which is at $120,000. They then could sell the old one, which really lowers the cost of the new machine. Yes? And so they could actually replace the equipment at a total cost of $615,000. Now, because we're talking about costs, we're going to pick the lower one here. Okay, the lower cost here would be to replace, because the cost would go down to have that. They would save $25,000 over that period of time if they bought or replaced the equipment rather than keeping the old equipment that they have or the current equipment. Nothing else matters. The cost of the old equipment doesn't matter because they already purchased it and they used it for a few years. It's irrelevant in this decision. The only thing that's relevant in this decision is what's the real cost of keeping it and what's the real cost of replacing it. Okay. All the money you spent on it in the past is irrelevant to the decision. It's just from this day forward. If we kept it, that's the cost. If we replaced it, that's the cost. That's incremental analysis. So should they retain or replace? Highly recommend that they dump it, replace, get the new machine. So again, just to know that the book value of the old equipment doesn't matter. It just doesn't matter because it's a sunk cost. They bought this thing a few years ago. They had to go through this, when they decided to buy that new one. The only thing that matters is if they actually going to get cash for selling it, because now that cash is going to offset the cost of buying the new machine. And so that's relevant. That's a relevant cost. But all the money they spent on this machine prior, what it's worth today on the books, we don't care because we are not looking at that. We're only looking at, do we keep it or do we replace it? So here is your do it exercise number 5, which is on page 288, smack dab in the middle of the page. Rochester Roofing has a decision to make. They rely very heavily on a 60-foot extension lift for work on their large homes and commercial properties. Well, they're doing roofing, they're going to need to get up there. Okay. Last year, the company spent 60 grand to refurbish the lift. Okay. It has just determined that another $40,000 is required now. Well, what's the alternative? Alternatively, they have found a new lift. It's used, but it's a newer lift than the one they have for 170 grand. The company estimates that regardless if they kept the old lift or they had the new lift, the useful life would be 6 years. They're going to be using this for 6 years. However, the new lift is more efficient and it would actually reduce expenses by $20,000 a year. Okay. Better still, when the company's not using the lift, they can rent it out for about another $2,000 of income per year. Okay. The old lift is not suitable for any rental, so you're not getting any additional money by keeping it. The old lift, however, can be sold off for 25 grand if they buy the new lift. So prepare the incremental analysis. Now, again, I want to show you this word here. As soon as you see this, last year they spent money on it. So what? They had to decide last year whether they should repair it or replace it. This is a different decision. So that number isn't good. You're not going to see that number anywhere. Okay. You're not going to see that number anywhere in the analysis. It's a sunk cost. All right. So if they retain the lift, well, the operating expenses are going to be $20,000 per year. And again, it has a 6-year life. So operating expenses of $120,000, that's how that numbers get there. They're going to need to repair it for $40,000. Okay. So right now they're looking at $160,000 just to keep the old lift as is. Okay. Over the cost of its life. Well, if they replace the equipment, they'll be able to rent it out for revenue, which actually lowers the cost of replacing the equipment. They're going to actually pay $170,000 for the new equipment, but they can sell the old equipment for $25,000 to offset the cost. So to actually replace the equipment, it would cost them $135,000 over that period of time. Okay. And so basically speaking, as you see, by buying the new equipment, well, the newer equipment compared to the one they already have, they'll end up saving $27,000 of costs, of expenses, which is the same as, if your expenses go down, your net income goes up, right? So to them, they're looking at, well, this would increase our profits by $27,000 over that 6-year period. So they'll look at it as a very, very good thing. Last but not least, incremental analysis is also used to help decide whether you should get rid of an unprofitable product or even an unprofitable sector of your business, a part of your business. Again, the focus should be on the relevant costs of the decision. Okay. You should know that overwhelmingly the fixed costs will not change. If they do change, it won't be by much. Okay, sometimes they do go down, but it's not by much. So that means that those fixed costs are going to be absorbed by any other products or any other segments of the business the company is keeping. Also know that because you're not selling that product or have that business generating revenue, your net income, your profitability might go down. when that unprofitable product is eliminated, or that's unprofitable part of your business is eliminated. So basically speaking, you're going to see that some companies will keep unprofitable segments or products, unless, of course, right, you retain it, unless those fixed costs eliminated are greater than the contribution margin that you've lost out. Okay. And so let's take a look at how this plays out. This is a company, Venus Company, they make tennis rackets, 3 different models of tennis rackets. They have the Pro, they have the Master, and they have the Champ. And so as you see here, the Pro is very profitable. They have $800,000 of sales, contribution margin of $280,000, and net income or profits of $200,000 on the Pro. The Master is also profitable, $300,000 of sales, $90,000 contribution margin, and a $40,000 profit. The problem is here. The Champ is, I don't know, the champ of losses. I'm not really sure what it's championing here. But they have $100,000 of sales and only a $10,000 contribution margin. After you take out the fixed costs that are attributable to Champ, Champ is losing 20 grand. So that was looking at it from the specific products. How does it affect the company overall? Well, the company overall, you add all your sales up, it's 1.2 million. You add your variable costs up, you add your contribution margin, 380,000. Add your fixed costs, 160,000. So overall, even with the losing product line, Champ, the company is profitable. It has a $220,000 profit. So I guess, should they eliminate Champ is the question. Well, we use incremental analysis to see whether it's a good idea to get rid of Champ, or if we do, we look like chumps. Not sure. All right, so if you eliminate Champ, just understand that those fixed costs are still sticking around. But now we're going to allocate 2/3 of the fixed costs to the Pro line and 1/3 of the fixed costs to the Master line. Let's go back and see. Our fixed costs are $160,000 total, right? $160,000 total. What we're going to do is we're going to break them into 2 pieces now, Pro and Master. If we get rid of Champ, this $30,000 is going to be moved over to these other lines. So 2/3 of it to Champ, 1/3 of it to the Master product. And so what you have is fixed costs for Champ are now $100,000, and your profit net income is $180,000. For your Master line of products, your fixed costs are going to be now $60,000, and you're going to have a profit of $30,000. In total, you're still going to have $160,000 of fixed costs. That doesn't go away. Of course, you lose the sales, you lose the variable costs when you get rid of it. Yes. But the fixed costs stick around. And so in essence, if they did this now, they would still be a profitable company, but their profit would only be $210,000. Remember, the profitability of the company, last year was $220,000. So if they ended up getting rid of Champ, yeah, all right, they would still be profitable, but the profit would be actually decreased by $10,000. So maybe it's not a good idea to eliminate Champ, even though right now it's not making any money. There might be other ways to deal with it. But if you eliminate Champ, you actually eliminate $10,000 worth of profit for the company. Okay. The incremental analysis, if we continue with Champ, we are going to lose money. We know that. But if we discontinue or eliminate Champ, we're still going to have the $30,000 of fixed costs that are not going away, which means our loss is bigger. So in essence, what this company should do is keep the champ around. Okay. All right. Let's assume, however, that if they did eliminate champ, $22,000 of the fixed costs can be eliminated. Okay. Well, now that's a different assumption now, because in the first assumption, we were just assuming none of the fixed costs would go away. We would just allocate them. But in this scenario, we're actually assuming that, yes, a pretty good chunk of the fixed costs will go away if we eliminate champ. So now it looks a little bit different. If we continued champ, we would still have 100,000 of sales, 90,000 of variable costs, and 30,000 of fixed costs, which means we'd lose 20,000. But if we eliminated champ under these conditions, that we would only have we would see 22,000 of fixed costs gone, then fixed costs would be reduced to 8,000. And now instead of losing $20,000 a year on champ, we'd only lose 8,000, which adds another $12,000 in profit, because what we don't lose, we keep. And so in this case, it's time for champ to pack the bags. Okay. All right. So again, the only thing we need to know here in the case of an unprofitable segment, if it's going to be eliminated, just understand that those fixed expenses will be absorbed in other ways. They don't totally go away. Even if they're reduced, they don't totally go away. And so that's something that has to happen. There's a company called Buck Knives. I don't know if you've heard about Buck Knives or not. They're a pretty sharp company. Ooh, a cut above, I don't know. But anyway, they basically looked at and did an incremental analysis whether they should actually move out of California to Idaho. They had 260 employees and they had a 170,000 square foot facility. So what did they do? Well, they looked at it from a financial, incremental analysis piece. First of all, electricity rates in Idaho were half the cost of California. And in this particular time period where they were doing this, electric rates were extremely high in California. Workers' compensation, which is a cost to the company, was a third of the cost it was in California. And wages were 20% lower. And this, combined, this would reduce manufacturing costs by $600,000 per year. Moving the factory would cost $8.5 million. Plus, they would be spending $4 million to move their key employees to Idaho. Okay. Offsetting these costs were $11 million that they think they would get by selling their California facility. So based on these estimates, and they're only estimates, the move would end up paying for itself within the first 3 years. And because they're looking long-term, that's great. Unfortunately, it didn't quite work out the way they had planned because, again, no one can predict the future with any certain degree of accuracy. I mean, we can have good guesses, but oftentimes we're wrong. Well, the company only got $7.5 million for its property. They were hoping to get 11 million. They only got 7.5 million. Only 58 of their 75 key employees were willing to go to Idaho. Okay. What's there? Tons of potatoes. So they didn't really get as many key employees to go. The construction of the new facility was delayed, which ended up increasing their price. And Idaho had really, at this time, which we're talking 2006, Idaho had really low employment. And so the wages started going high because there's only so many people in Idaho. And if you have to compete for workers and there's only so many workers around, the best way to compete for workers is to increase your wages. And so despite these complications, it might have taken longer than 3 years for things to work out for them, but they did say the move was a great success. Okay. All right. Your last little thing here is on page 290. It looks at, again, unprofitable segment and whether you should continue doing it, even though it's losing money, or eliminate it. Right. Eliminate the segment. So Lambert here, they manufacture several types of accessories. They have hats, knit hats and scarf line that had sales of $400,000. Their variable costs were $310,000. Their fixed expenses were $120,000. And you see that here in total. Okay. Therefore, their knit hats and scarves line ended up losing 30 grand. If Lambert Company eliminates the hat and scarf line, $20,000 of fixed costs would still remain. So prepare the analysis whether they should continue or eliminate. Well, if they eliminate, they wouldn't have any sales. They wouldn't have any variable costs. They wouldn't have any contribution margin, but they still would have these $20,000 of fixed costs. So they would end up losing $20,000. But losing $20,000 is better than losing $30,000, because ultimately that means that additional $10,000 would be added to the profit of the company. Right? If your costs are lower, those that contributes to your net income. So in essence, if they eliminate, they would lose money, but they would lose less money. And thus the additional money that they would not lose technically is the profit for the company. So in this case, they would go ahead and eliminate. Which is hard because I think we all need scarves and hats these days, at least by Friday.